Good morning, I'm Chad Justice and welcome to Market Monday for March 9th, 2026. Before we get started, just a quick reminder, we're not tax professionals. And today is general education only. And as always, coordinate tax decisions with your CPA. April 15th is just over 5 weeks away. Most people think about taxes once a year when they file, but the most impactful strategies usually happen before filing. And a few deadlines are coming up fast. Let's start with one of the most overlooked tools in retirement, the Qualified Charitable Distribution, or QCD. If you're 70 and a half or older, you can transfer up to $180,000 per person directly from your IRA to a qualified charity. That transfer counts towards your required minimum distribution. And because it never hits your taxable income, it keeps your adjusted gross income lower. And a lower AGI can reduce taxes on Social Security. It can also help you avoid Medicare income surcharges. So if you're already giving to charity and taking IRA withdrawals, this is simply a more efficient way to do both. And if you don't qualify for a QCD, consider a donor-advised fund. The standard deduction for a married couple is now over $31,000. That's a high bar. One strategy is called bunching. You can combine 2 or 3 years of donations into one tax year. You take the full itemized deduction that year. Then you take the standard deduction in the off years. Same giving, just better tax efficiency. Last week we touched on Roth conversions, so that's worth expanding on that also. A Roth conversion moves money from a traditional IRA into a Roth IRA. And you pay taxes today in exchange for tax-free growth and withdrawals later. So timing really matters. And conversions often make sense when your current tax rate is lower than what you expect in the future. And that can happen during retirement, between jobs, or in a lower income tax year. With tax provisions still evolving, it's worth revisiting the math. For higher income earners, there's another strategy worth mentioning, the Backdoor Roth. It allows individuals who exceed income limits to still move money into a Roth account. The mechanics require care, and done incorrectly, it can create unintended tax consequences. We won't go deep into it here, but it's worth asking about. There are 2 more items with April 15 deadlines. First, HSA contributions. If you have a high deductible health plan, April 15th is the last day to contribute to your 2025 health savings account. HSAs offer a tax deduction going in, tax-free growth, and then tax-free withdrawals for qualified medical expenses. Few tools check all those boxes. Second, estimated tax payments. April 15th is also the first estimated payment for 2026. And if your income changed this year, your payments may need to be adjusted. A quick review now can prevent a surprise next April. Tax planning is not a once-a-year thing. It's an ongoing process. If anything we covered today raised a question, just reach out. We're happy to work alongside your CPA and keep your strategy aligned. And as always, review any tax strategy with your tax professional before you implement it. That's all we have for you today. Thank you for watching this week's edition of Market Monday, and join us again next Monday for more of the insights that matter to your money.